All right, let's get straight to it. Today we have a single focus, defining precisely where a trade ends. We're going to remove every other variable, entry, stop loss, how much you hope to make, and concentrate only on the logical conclusion. This whole exercise is about planning your exit with absolute objective clarity.
So let's start with a really fundamental question. What even is a trade's target? Is it some number you're just hoping to hit? A profit goal you've set for yourself? The answer to this question really gets to the heart of the conflict for most traders. It's that constant battle between emotional hope and cold, hard, logical analysis.
And this slide really lays out the two paths you can take. On one side, you've got the wish for profit. This is all based on emotion, on greed. The question here is, how much can I make? But on the other side, we have the logical boundary. This is based purely on market structure, and it asks a totally different question. Where does this trade logically end? This is objective, and it is the only path forward.
Let's be perfectly clear on this. Targets are not about greed. They're about logic. We're not fortune tellers trying to predict the highest possible price. We're planners. We are simply identifying the most probable point where the price is likely to run into some serious trouble. That's it.
You have to understand just how critical the target is. You could have a picture-perfect entry signal, an absolutely ideal setup, but if it doesn't have a logical, well-defined target, the whole trade is invalid. A good setup with a bad target is still just a bad trade. The exit isn't an afterthought. It's a non-negotiable piece of the plan.
So how do we actually define a target the right way? Well, we use non-negotiable rules, and these aren't just suggestions or guidelines. Think of them as a strict, objective checklist. If a potential target doesn't meet every single one of these criteria, it's out.
Okay, let's break these rules down. First, location. The target has to be at a previous swing high or the next clear resistance zone. No exceptions. Second, the time frame. It must be clearly visible on the daily chart. This helps filter out all the distracting noise. Third, its foundation. It has to be structural, based on the chart, not some arbitrary profit goal you made up. Fourth, reward versus risk. It needs to allow for at least an estimated 2-to-1 reward for the risk you're taking. And finally, number 5, and this one's crucial, the exit is predefined. That means no trailing stops, no wait-and-see attitude. The exit is locked in before you ever hit the buy button.
And the consequence of this checklist? It's absolute. If any single one of these rules fails, the trade is rejected, period. There's no negotiation, well, it's close enough. The system is binary. It either passes all the checks or it's discarded immediately.
And here's the point of all this. We do not force trades. We just respond to the conditions the market gives us. So if the market can't offer an exit that meets our rules, well, that's a crystal clear signal to do nothing. We just step aside without emotion and we wait.
Okay, now let's turn this into a mental exercise. Because the way you get good at this isn't by finding winning trades. It's by building the discipline to reject the flawed ones. The primary skill you're really developing here is analysis, not prediction.
I want you to reframe your entire objective. For this exercise, your task is not to find trades. It is to find flaws. You are a quality control inspector. Your only job is to look at a setup and actively search for reasons to disqualify it based on the target logic we just covered.
This brings us to a concept I call forced rejection. See, saying no to a trade setup isn't a failure. It's actually a successful outcome. It proves that you're thinking critically and sticking to your rules. It's a required discipline, not a sign that you couldn't find anything good.
So what are some valid reasons for rejection? Well, they're simple and objective. Is there no clear resistance ahead? Rejected. Is the target way too close, not offering enough room to move? Rejected. Does the potential reward not justify the risk? Rejected. Is the price already slammed right up against a resistance zone? Rejected. See? Clean, logical disqualifications. This all brings us to your mandate. The core lesson here has to become a strict command for all of your future planning. You must think about the exit first. And to really burn this into your brain, you have to lock your boundary. You need to focus on this one single task, defining the exit. By isolating just this one variable, you'll build the mental muscle you need without getting distracted by anything else. So to make sure you stay focused, these items are forbidden for this exercise. Don't think about the entry price. Don't think about the stop loss. Don't worry about the exact reward to risk calculation or your position size. The only question you have to answer is, where does this trade logically end? Why are we being so intense about this? Because without a predefined, logical target, your discipline will absolutely collapse when you're in the heat of the moment.
A vague plan always leads to emotional decisions, holding on too long, selling way too soon. A clear endpoint is the anchor that keeps your plan objective and your actions disciplined.
So I'll just leave you with this question. Take a look at your next potential trade. Is its conclusion defined by hope, or is it defined by a clear, structural, logical endpoint? Because the answer determines whether you're gambling or actually executing a professional plan.